I need you to pay very close attention right now because what silver is doing at this moment is not normal. And in my years of watching markets, I have learned that when silver starts behaving like this, it is rarely just about silver. It is usually about something much bigger moving beneath the surface. The speed of the moves, the sudden spikes followed by violent pullbacks, the strange gaps between futures markets and physical demand. These are not random fluctuations. These are signals. And markets always whisper before they scream. Look at what we are seeing together. Silver has been moving in wide, unstable ranges, sometimes swinging in ways that resemble crisis periods more than stable expansion cycles. You are watching a metal that is both an industrial input and a monetary barometer. And when those two identities collide, the price behavior becomes a kind of early warning system. I have seen similar patterns before, not identical, but familiar enough to make any macro observer uneasy. In the late 1970s, in the early 2000s, and again in the years surrounding the global financial crisis, silver began to move erratically before broader stresses became obvious to everyone else. What makes the current situation more concerning is not just the price level, it is the structure behind the price. Inventories in key trading hubs have been declining, while demand, both industrial and investment related, has remained strong. The ratio between paper claims and available physical metal has widened in ways that make delivery strains more likely during periods of stress. At the same time, option markets have produced sudden volatility bursts that resemble liquidity, squeezes rather than orderly repricing. When liquidity thins, markets do not adjust smoothly, they snap. And silver, more than most assets, reflects those fractures early. Now, ask yourselves why this is happening. This is not a single cause phenomenon. The global financial system is carrying levels of sovereign debt that would have been considered extraordinary just a generation ago. Real interest rates, while positive on paper, remain historically compressed when measured against the pace of monetary expansion over the last decade. Central banks have slowed tightening, but they have not restored balance sheets to pre-crisis norms. In other words, the system is still saturated with liquidity, but that liquidity is unevenly distributed, and uneven liquidity is one of the classic precursors to volatility events. At the same time, inflation has not fully retreated to the comfort zone policymakers once promised. Even where headline numbers appear calmer, underlying price pressures in services, wages, and energy remain persistent. Historically, when inflation stabilizes above target while growth remains uneven, capital begins to migrate quietly into stores of value. That process is rarely dramatic. At first, it begins slowly, almost invisibly, and then, suddenly, everyone notices at once. And here is the part that confirms this is not an isolated signal. Central banks themselves have been accumulating gold at one of the fastest paces in modern history. Large institutional flows have been moving into precious metals, exchange-traded products. Industrial demand for silver continues to expand due to electrification, photovoltaics, and advanced electronics manufacturing. These are not speculative narratives. These are structural forces. When you see governments, institutions, and industries all interacting with the same assets in different ways, you are looking at a convergence of motives. And convergence is what drives powerful long-term trends. But there is also a contradiction, and I want you to notice it clearly. Equity markets remain resilient. Credit markets are not signaling panic. Volatility indices are elevated but not extreme. On the surface, everything appears stable, even optimistic. Yet beneath that surface, currency pressures are building in several regions. Debt servicing costs are rising, and liquidity conditions in parts of the global system are tightening. This is the kind of divergence that often precedes inflection points. Markets do not break when everyone expects them to. They break when confidence and underlying reality begin to drift too far apart. So here is the conclusion I have reached, and I want you to understand this not as advice, but as an observation formed after many years of watching cycles unfold. Silver is not simply rising or falling. It is signaling. It is reflecting stress in supply chains, tension in monetary policy, and uncertainty about the durability of the current financial environment. Whether that signal turns into a full systemic shift or fades into another volatile chapter depends on forces still unfolding: interest rates, liquidity, geopolitical developments, and the behavior of currencies. But one thing is clear as we stand here looking at these charts together: silver has started to speak. And in macroeconomics, the most dangerous mistake you can make is ignoring the first warning. I want you to step back with me for a moment and look at the bigger picture, because what is driving gold and silver higher right now is not a single headline, not a single war, not a single policy decision. What you are seeing is the result of multiple tectonic forces moving at the same time. And when those forces align, markets do not move slowly, they accelerate. The first force you need to understand is debt. Global sovereign debt has crossed levels that, historically, only appeared during wartime or severe crises. Governments across the developed world are now spending large portions of their budgets just to service interest payments. I have watched this dynamic before, and every time debt burdens rise to this degree, policy makers face the same dilemma: either tighten financial conditions and risk recession, or maintain liquidity and tolerate inflation. There is no painless path, and markets know it. Now, look at inflation itself. Many people believe inflation has been defeated because the headline numbers have cooled from their peaks, but that is only part of the story. Core inflation remains sticky in many advanced economies, especially in services and wages. Energy and food prices continue to fluctuate unpredictably, and wage growth in several regions remains elevated. Historically, when inflation stabilizes above central bank targets, confidence in fiat purchasing power erodes gradually, not dramatically. That erosion is subtle, but it changes behavior. Investors, institutions, and even governments begin to shift their reserves quietly, almost defensively. At the same time, monetary policy is no longer synchronized across the world. Some central banks are pausing, others are easing, and some are still fighting inflation. This divergence creates volatility in currency markets, and currency volatility always finds its way into commodities. A weakening dollar combined with persistent global liquidity has historically created powerful tailwinds for precious metals. We saw this in the 1970s and again in the early 2000s. The mechanism is simple but powerful. When real yields fall or become uncertain, non-yielding assets regain their appeal. But there is another driver that many people underestimate, and that is structural demand. Silver is not just a monetary metal, it is an industrial one. The global push toward electrification, renewable energy, and advanced electronics has increased the baseline demand for silver year after year. Solar panels, electric vehicles, high-efficiency circuits. These are not temporary trends. They are part of a long-term transformation of the global economy. When you combine structural industrial demand with monetary demand, you create a powerful and often volatile feedback loop. And then there is geopolitics. You are living in a world where major powers are redefining trade relationships, building parallel payment systems, and diversifying reserves away from traditional currencies. Central banks themselves have become some of the largest buyers of gold in recent years. That is not speculation. That is policy. When institutions with multi-decade time horizons begin reallocating reserves, they are not reacting to daily price movements. They are responding to structural shifts in the international monetary order. I also want you to notice something that many commentators overlook. Liquidity globally has not disappeared. Money supply growth has slowed compared to the extraordinary expansion of previous years, but it has not reversed in a meaningful way. Balance sheets remain large. Financial conditions, while tighter than before, are still far from restrictive in historical terms. This environment, moderate inflation, high debt, uneven tightening, and persistent liquidity is exactly the kind of environment in which hard assets tend to perform strongly over long periods. But there is a tension here, and I want you to feel it clearly. Economic growth has not collapsed. Equity markets remain resilient. Employment data in several major economies still appears stable. And yet, beneath that stability, the foundations are shifting. Debt burdens are rising, geopolitical risks are multiplying, and monetary systems are slowly fragmenting. This is not the kind of instability that appears overnight. It is the kind that builds quietly, layer by layer, until one day, everyone realizes the system has already changed. So when you see gold holding near historic highs and silver moving in powerful, sometimes violent waves, do not think of it as a simple rally. Think of it as a reflection, a mirror held up to the global financial system. It is showing you the pressure of debt, the persistence of inflation, the uncertainty of currencies, the transformation of industry, and the quiet repositioning of central banks. These forces are not temporary. They are structural, and structural forces, once in motion, tend to shape markets for years, not weeks. I want you to focus with me now, because this is the part of the story that most people never see. Prices are visible to everyone. Headlines are visible to everyone. But the structure underneath the market, that is where the real signals appear first. And right now, those signals are flashing in ways that should not be ignored. When I look at the precious metals markets today, what concerns me is not only the direction of price, but the behavior of the system that supports those prices. You are looking at a market where physical inventories in major exchanges have been declining, while trading volumes in paper contracts remain enormous. This is not new in itself. Paper markets have always been larger than physical markets, but the scale of the gap has widened in ways that are historically unusual. There are far more claims on metal than metal that can realistically be delivered in a stress scenario, and that kind of leverage works smoothly only as long as confidence holds. I have seen this pattern before in different forms. In the late stages of the Bretton Woods system, gold outflows began quietly before the system finally broke in 1971. In 2008, funding markets showed stress months before Lehman collapsed, but most people were still focused on equity prices and earnings reports. Structural stress rarely announces itself loudly at first. It shows up in spreads, in inventory levels, in the small technical signals that most investors never notice. Right now, you can see these signals in backwardation episodes, in sudden spikes in lease rates, and in the persistent premiums appearing in some physical markets compared to futures prices. These are not normal conditions in a well-balanced commodity market. Backwardation in a monetary metal suggests urgency in physical demand. It suggests that someone, somewhere, is willing to pay more today than tomorrow, and that is not the behavior of a relaxed market. At the same time, volatility patterns have changed. You are seeing intraday moves that are sharper than what fundamentals alone would justify. This is often a sign of liquidity pockets forming and disappearing rapidly. In modern markets, liquidity is not a constant pool. It is algorithmic, fragmented, and highly sensitive to risk conditions. When liquidity thins, price discovery becomes unstable. Moves become exaggerated, corrections become violent, and silver, because of its smaller market size compared to gold, becomes a kind of amplifier for those stresses. There is another layer to this that you need to understand, and that is the divergence between regions. Physical premiums in parts of Asia have been noticeably higher than prices quoted in Western futures markets at various moments. That tells you something important. The global market is no longer perfectly synchronized. Capital controls, export restrictions, and strategic stockpiling are beginning to fragment what was once a unified global pricing mechanism. When markets fragment, arbitrage becomes harder and price distortions last longer. That is a classic late cycle phenomenon. And then there is the issue of supply itself. Mining output cannot increase overnight. New projects take years to develop, sometimes decades. At the same time, industrial demand continues to rise steadily. When supply is inelastic and demand trends upward, the system becomes more sensitive to shocks. A small disruption can have an outsized effect. This is not speculation, it is basic commodity economics. But here is the contradiction that makes this situation so difficult to interpret. Financial markets, broadly speaking, are still functioning. Credit is available. Governments are still issuing debt successfully. Equity markets have not collapsed. From a distance, everything appears stable. Yet beneath that surface, structural imbalances are growing. Imbalances in debt, in liquidity distribution, in supply chains, and in monetary trust. These imbalances do not cause immediate collapse. They create fragility. And fragility means that when a shock finally arrives, the system reacts faster and more violently than anyone expects. I want you to understand this clearly. What we are observing is not proof that a crisis is imminent. Markets can remain in fragile states for long periods of time, but fragility itself is a signal. It tells you that the margin for error is shrinking. It tells you that policy mistakes, geopolitical events, or sudden liquidity withdrawals could have larger consequences than they would in a more balanced system. And this is why I keep coming back to silver. Not because it is magical, not because it predicts the future with certainty, but because it reflects stress earlier than many other assets. It sits at the intersection of industry, finance, and monetary psychology. When those three forces begin to pull in different directions, silver becomes unstable. And instability in macroeconomics is rarely random. It is usually the surface expression of deeper structural strain. So, as you stand here listening to me, I want you to remember this moment, not as a prediction, not as a warning of an inevitable outcome, but as a snapshot of a system under pressure. The signs are there, in inventories, in volatility, in premiums, in liquidity behavior. These are the kinds of signals that experienced observers learn to watch, because by the time the headlines arrive, the story has already begun to unfold. I want you to stay with me for these final minutes, because this is the part where we stop looking at what has already happened and begin looking at what could happen next. And I need you to understand something clearly. The future in macroeconomics is never a straight line. It unfolds in scenarios, in probabilities, in paths that depend on forces that are still moving right now as we speak. The first path is the one many markets are quietly beginning to price in. If inflation remains stubborn, if governments continue running large fiscal deficits, and if central banks are forced to maintain relatively loose financial conditions to prevent debt servicing crises, then the environment that has supported hard assets could persist for years. History gives us examples of this. The 1970s were not a single event. They were a prolonged period of monetary instability, currency adjustments, and rising commodity prices. It did not happen in a straight upward line. There were corrections, sharp reversals, moments when everyone believed the cycle was over, only for the underlying forces to reassert themselves again. But there is another path, and you need to understand this one as well. If bond yields begin to rise sharply again, if central banks are forced to tighten more aggressively than expected, or if a sudden contraction in liquidity occurs, markets can reprice very quickly. We have seen this many times. In 2013 during the taper tantrum, in 2018 during the global liquidity squeeze, and in 2020 during the initial pandemic shock, markets moved with extraordinary speed once liquidity conditions changed. Liquidity is the oxygen of financial systems. When it becomes scarce, even strong markets struggle to breathe. And then there is the third scenario, the one that rarely gets discussed openly, but is always present in the background. A gradual shift in the global monetary order. Not a collapse, not a dramatic overnight event, but a slow redistribution of trust. When countries diversify reserves, when trade begins to settle in multiple currencies, when commodities are increasingly priced outside traditional systems, the structure of global finance evolves. These transitions take years, sometimes decades, but during those transitions, volatility tends to increase, not decrease. So, what should you watch? Not headlines. Headlines come too late. Watch real interest rates, because they tell you whether capital is being rewarded or quietly eroded. Watch the strength or weakness of major currencies, because currency instability often precedes broader financial instability. Watch liquidity indicators, credit spreads, funding markets, central bank balance sheets, because liquidity changes rarely announce themselves politely. And watch the behavior of assets like silver, not as a crystal ball, but as a barometer of stress and confidence. I also want to remind you of something that experience has taught me again and again. Markets do not move because of a single event. They move because of accumulated pressure. Think of tectonic plates beneath the ocean. For years, nothing appears to happen. Then one day, the pressure releases, and the world calls it a sudden event. But it was never sudden. The forces were building long before anyone felt the tremor. Right now, we are in one of those periods where pressure is building in multiple areas at once. Debt, inflation persistence, geopolitical tension, currency realignment, and structural shifts in industrial demand. None of these forces alone is enough to reshape the system. Together, they have the potential to. And this is the most important point I want you to take away as we close. The goal is not to predict the exact day or the exact trigger. No one can do that consistently. The goal is to understand the environment you are living in. We are no longer in the low inflation, synchronized growth world that defined the decade before 2020. We are in a different era now, an era of fragmentation, higher volatility, and competing monetary strategies. So, as you leave this conversation, I want you to remember what we have seen together. Silver flashing early warning signs, gold holding strength in the face of shifting policies, liquidity still present but uneven, debt levels historically high, inflation no longer fully controlled, central banks cautious but constrained. These are not isolated facts. They are pieces of a larger picture. And when you put those pieces together, you begin to see the outline of what may come. Not certainty, not inevitability, but possibility. And in macroeconomics, understanding possibility is often more valuable than believing in certainty.